Hello, hello, hello. Welcome to my presentation on income replacement from investments, take 703. I want to welcome you to this presentation. I hope you enjoy it. What I'm going to talk about are 7 ways that you can invest to generate income to help replace your earned income after you retire. We're going to talk about I call them the 3 most common investment sources: bonds, dividends, and CDs. And perhaps less well known or less utilized are REITs, real estate investment trusts, preferred stock, convertible bonds, MLPs, master limited partnerships. Toward the end of the presentation, I'll just do a comparison of the yields and returns for each of these 7 types of investments, and I'll present an example of how much income you could generate based on one set of assumptions. Okay, let's go. The purpose, again, to this presentation is to show ways that you can generate investment income to help replace earnings after you retire. This presentation is informational only and makes and offers no recommendations. You should always seek professional guidance when managing your finances. That said, I have owned at one time or another each and every one of these 7 types of investments I'm going to discuss. The scope. We're going to generate income from taxable investment accounts only. We're not going to include pensions, Social Security, tax-deferred accounts such as 401ks, annuities, and we're not going to worry about the effects of inflation or currency exchange rates. First up, bonds. Bonds are fixed income securities issued by corporations and government entities. Interest payments are tied to risk and prevailing interest rates, and each bond has a face value, sometimes called the par value, of $1,000. Now, the pros of owning bonds are you get a predictable income stream, either quarterly or semi-annually often, and the amount is the same, so you don't have to worry about things fluctuating. Some bonds are tax-free, and those usually are from the federal government, state governments, municipal governments, in other words. And that's a great boost to your income. You don't have to pay tax on these interest returns. They're less risky than stocks, and they offer many options for purchase. So that's great. There's lots of different ways that you can own bonds. And they're great for diversification. Probably the number one way that people diversify their overall investment portfolio is including some allocation for bonds. On the negative side, they can lose money, and everything can lose money, but I just want to make it clear that even bonds can lose money. They're not as liquid as stocks, and if you've ever gone to buy a bond or sell a bond, you know that they're not as transparent. You don't really know what the fees are because they're kind of hidden, and it makes them a little bit more complicated than buying individual stocks, for example. Next up, dividends. So a dividend is an amount tied to a share of common stock, typically paid out on a quarterly basis. And it's important to understand that payment of dividends is voluntary. A corporation does not have to pay dividends, even if they've already started so. On the plus side, many corporations increase their dividend payout over time. So as they raise their dividends, you're essentially getting a raise yourself, which helps combat the effects of inflation, for example. And dividends help increase the rate of return on equities. So if your stock goes up, say, 6% in a year and you've got a 3% dividend yield, you've got a nice 9% total return on that stock. And as I mentioned earlier, corporations can reduce or eliminate dividend payments at their discretion. If that happens, it's usually indicative that a company in trouble, and undoubtedly the underlying stock is going south too. Next of the 3, as I call most common ways of generating income, are certificates of deposit. Now, a CD is a savings certificate with a fixed maturity date, often 12 months, 18 months, 2 years, and they typically offer a fixed interest rate. On the plus side, they offer better returns than money market funds, and they are FDIC insured up to $250,000 per person. On the less positive side, if you have to take your money out, there is a penalty for early withdrawal, and the yields that they offer are relatively very low. Next, we're going to talk about 4 investments that are perhaps not quite as common or maybe as well understood or used as the 3 I just mentioned. First are REITs, real estate investment trusts. That should be a little S. A REIT is a security that invests in property or mortgages and trades on major exchanges, which is awesome. They are required to pay out 90% of their earnings as dividends. So they can produce a lot of income, which is what we're looking for. On the plus side, it is a liquid way to invest in real estate. That's a great way. That's really, don't underestimate how great a feature that is. Returns are usually higher than dividends or interest. So that's another great thing going in their favor. And there are many different types of real estate to invest in. So you can get a REIT that can do shopping centers, medical complexes, apartments, you name it. And you can get kind of a mutual fund or an ETF that is a combination of REITs, a collection of REITs. So there are many different ways that you can participate in real estate without actually having to physically own it. And REITs are an excellent means of diversification because they are not correlated with stocks and bonds. But what I mean by that is that if a stock and a bond is going up or down depending on market conditions, global geopolitical types of things, interest rates, a REIT doesn't necessarily move in the same direction or the same magnitude as a stock or a bond will, which makes it a really great candidate to help diversify your overall portfolio. On the less positive side, if you happen to purchase a REIT that is what's called a closed-end fund, they're not going to be as transparent as a REIT that's traded on a major exchange, and they may have upfront fees and are therefore considered illiquid. But on the other hand, they do tend to sell at attractive discounts. So, so even though negative has a silver lining. Next, preferred stock. So preferred stock is a class of ownership in a corporation, as is all types of stock. Common stock is a type of ownership or class of ownership. Dividends can be fixed or tied to a benchmark. They combine the features of debt and equity, so they're hybrid in a sense. On the plus side, they generally yield more than common shares. They have a higher claim on assets and earnings than common stock, which means if a company has to liquidate, go to Chapter 11, the people who hold the preferred stock get their payments sooner and perhaps at a higher percent than people who own common stock and on down the line. Dividends must be paid out to those before those are common shareholders. Again, you got more protection if something is happening where they're changing up their dividend payouts or the company has got some financial issues. You got a little more protection. And they have no maturity dates. On the negative side, they carry no voting rights. I don't think that's a big deal when millions of votes are outstanding and usually held by the owners of the company and the board of directors. Underlying shares usually do not appreciate as fast as common shares, so they behave more like a bond than they do like a stock. Next, convertible bonds. These are debt securities that might be converted into a set amount of common stock at certain times. And if those certain times are presented or offered by the underlying bond holder, and then you have the option of doing the conversion or not. And typically, you would want to do that because that's one of the reasons why you buy a convertible bond, is you buy it with that option that over time you'll then be able to convert a share, one convertible bond into n number of stock shares. So again, it's a hybrid security. It's a bond with a stock option, which is kind of cool. The pros. It provides income while you're waiting for the company's stock to appreciate. The principal is returned at maturity if you buy a convertible bond individually. ETFs offer an easy way to purchase a basket or collection of convertible bonds. So you don't have to worry about the principal being returned at maturity. On the negative side, they have lower interest rates when issued, but again, we kind of covered that there. They may be callable, and some people may view them as too complex to bother with. I don't think that's such a big deal. I think if you put your head to it, put your mind around it, they're not that complex. But these are a different animal altogether. Master limited partnerships, a business organization of publicly traded limited partnerships. They are common in the energy sector. They must generate 90% of profits from production, processing, storage, and transportation of depletable natural resources. On the plus side, they offer the tax benefits of a partnership. And that really means you avoid double taxation. They pass through the profits to the limited partners, which if you buy one, you are a limited partner. And as a limited partner, you can record prorated depreciation to reduce liability, which can offset distributions received. They might be able to see how this could become a very lucrative type of investment. And they are publicly traded, which means they are liquid, which is, again, a great feature. On the less positive side, I think probably the number one issue is they are complicated. You do not get a 1099, you get something called a K1. So tax preparation becomes more challenging. and they're absolutely not well suited for deferred tax accounts such as a 401k. Okay, next, here's some performance history from 2016 for examples of these types of investments. So for bonds, we're using what's the ETF called LQD, investment grade corporate ETF. Dividends, the Vanguard Dividend Appreciation ETF, Capital One 12-month CD for a REIT, Fidelity Real Estate Income, it's really a mutual fund. This is an ETF, PFF, iShares Preferred Stock ETF, CWB, Barclays Convertible Securities ETF, and as an example of an MLP, Energy Transfer Partners. Here you can see our yields and our one-year return, which combines the yield with appreciation. That one I can't vouch for. It is a data point I found online, but I cannot necessarily attest to it. As I mentioned earlier, the financial analysis around MLPs is more challenging than your traditional stock, for example. Now, what if you had $100,000 and you spread it across these 7 instruments, $15,000 for everything except the CD, where they've just put $10,000. With those yields, you generate $4,400 a year. Obviously not enough to replace all of your earned income, and you can, of course, spread this $100,000 differently. You might could take on more risk perhaps and increase that or decrease it by perhaps investing in less risky securities. Just an example of how you could stretch $100,000 and perhaps how far you would have to go to replace all of your earned income. And we're going to wrap up with the following. Income replacement is an adjustment. It's budget-wise. You have to factor in the fact you're now getting income from different sources. And for me, psychologically, paying yourself as opposed to getting a paycheck, that takes a bit of an adjustment psychologically. As I mentioned kind of throughout the presentation, there are other ways to replace earned income, including pensions, Social Security, work in some form, reducing expenses, which is one way I think is sort of the antithesis or the opposite of getting income, is just reduce your expenses. It's like retiring debt. And 401k distributions. Lastly, investment income is just one way to replace your earned income. I hope I've shown you some viable ways that you can do so. Please feel free to research this on your own, consult with your financial advisor, and you can send me a question if you wish to using the contact form on retirementjourneys.com. Thanks for your attention. I hope this was helpful, and I wish you all the best when it comes to replacing your earned income in your retirement. Take care.